Welcome to The Curve Weekly, the podcast that keeps you up to date with all of the money, business, and stock market tea.
Brought to you by the Curve's research team. It's the latest insights on what's happening in the stock market, companies, other money-related news so that you can stay educated and ahead of the curve.
You can thank us later for sounding smarter than those finance bros at your next dinner party.
We've got so much to get through today.
So much.
Before we get into the first thing we're going to speak about, I just want to mention we are going to be speaking about quite a few interesting investment opportunities in this episode. Some incredible thoughts around some of the research Vic's done with ETFs and the US stock market and what's going on, because there's a lot of headlines at the moment. There's some interesting stuff happening with Tesla.
And the luxury companies in Europe.
Yeah, there's some big things happening. So we're going to start with gold and talking about some of the stuff happening in the election and move on to some bigger picture thoughts around what's happening when it comes to investing. Some really interesting data that's come out from Goldman Sachs, one of the biggest investing, would we say companies in the world?
Investment banks, yep.
And then moving on to periods in investing, which might sound bizarre, but just trust us, it's actually quite a fun convo. So gold at the moment is at an all-time high. And I don't know why I'm interested in this. I think it's because gold is such an easy thing for me to understand. I get what? Gold. Oh my God, you keep using weird hand movements today and I'm feeling
and I
lost.
forget this is an audio podcast. Yeah. It's like, what's she doing?
Would you like to explain it? Because I don't.
I held up my finger with a gold ring on it.
No, I mean explain what's happening with gold.
Wow.
Jesus,
Okay.
this is sorry. There's been minimal sleep this week.
Why have you minimal sleep, Sophie?
No, trust me, there's nothing sexy happening at all.
She came into the office the other day. She's like, I'm storing last night's clothes. I was like, wow, someone had a good night. She's like, no, because I went to an event and then I couldn't be stuffed figuring out what to wear, so I just put on last night's clothes. I was like, damn, I thought I had a juicy story.
You know when you hear people like Stephen Bartlett being like, or, massive tech entrepreneurs talking about how they just wear a black t-shirt because they get decision fatigue and blah, blah, blah. I really honestly.
Like Steve Jobs.
Yeah, it was one of those moments where I thought, I know this outfit. I like this outfit. I chose it last night. I'm putting it straight back on. And then it's just a non-thought. Sometimes I
love in the shower or like on a walk being like, what am I going to wear today?
Really?
Like it's quite fun.
God, I can never think.
Anyway, gold. So yes, like you said, gold is at an all-time high. So this is all because of the US election, pretty much. It's caused a lot of uncertainty. It's the closest election that we've ever had, pretty much. And so that creates a lot of uncertainty for the market, which the market hates, which means people are like, I don't know what the stock market's going to do. I'm going to hold something safe like gold.
Oh, so they're actually interrelated, the gold story and the election story.
Yeah, we've also got a war in the Middle East going on. That's freaking people out. We are going to have interest rate cuts. Like there's a lot going on in the world right now that people are like, global world fatigue. I'm going to just invest in gold because right now I don't know what's going on in the world.
It's so interesting because now I'm thinking about that, like the way you've explained it, and it makes sense for actually quite a few of the stories and headlines and news that we're going to speak about today. It's a really interesting time in the world to feel secure about anything. There's environmental stresses. Who's going to be the most powerful person in the world? If it's not that, it's a war happening. There is.
If it's not that, it's the cost of living crisis.
It feels like just an absolute overwhelm. People just need some kind of certainty, and the idea of gold being something you can put your money in that is a tangible physical thing. It doesn't change shape.
Yep.
It doesn't change what it's used for.
I mean, okay, yep.
But do you know what I mean? It's a really
it's the first thing that was pretty much ever traded.
It's also kind of controllable in a weird way. So I understand the sense of relief or turning to things like that in a time that feels incredibly overwhelming.
Do you think there's more things happening in the world today than there was, say, 10 or 20 years ago? Or do you think we've got just information overload? See it visually through social media? Because I kind of do. I think that plays into it. I don't disagree. I think there is a lot going on in the world, but I think it's much more heightened than it probably would have been kind of 10 or 20 years ago.
But it does feel like a lot of things are happening at the same time. I think for me, the biggest and scariest part is the environmental crisis that we're facing at the moment and the extreme diversity of thought, the fact that someone is going to be potentially in leadership that has the complete opposite. In fact, is promoting drilling into the earth instead of how can we make sure that we're protecting the world for generations to come. And maybe social media is magnifying the shit out of it. I personally sometimes have to completely tune out of a lot of news because I just can't. I find it way too emotional. And I feel really powerless with knowing what to do.
It's interesting you say that because I feel like the whole environmental focus has fallen off a cliff because of everything else going on in the world. Even people being able to buy organic now, they can't afford, so they're buying, non-organic. People that want to buy a Tesla, but they're like, you know what, I can't afford, I'm just going to have to buy a car that I can afford. Like that kind of stuff. When you're in a cost of living crisis or inflation's super high, everything seems super tight.
It's a privilege to think about your
it becomes
values.
A second thought. Yeah. And I know we spoke about it in our election podcast, which is Raising the Curve 139. But yeah, it's interesting that that's your concern about the election. It's different for everyone. Yeah.
I think what we're going to get into next is just a quick overview.
Should we take a bet?
Oh, no.
Who's going to get in? I reckon Trump.
No, but I kind of think Trump is too. And that's kind of the issue is that scares me so much.
I put out the best Curve Weekly newsletter last
Did you?
week. Yeah.
Based on stats and people opening it, or is this based on your own?
Based on
I love that.
My own, but also I had one lady come back and she said, oh, I loved the Trump reference. So there's been a E. coli outbreak at McDonald's and the share price has fallen. And anyway, I spoke about that. Also the same week, Trump was at McDonald's serving people.
You're kidding.
And there's this photo that's gone viral. He was trying to get votes and I'll serve at McDonald's as a PR thing. And McDonald's is like, we do not endorse Trump. Anyway, now they've had this E. coli outbreak and everyone's like, oh. And so the headline that I put in the Curve Weekly was McDonald Trump.
Oh,
quite good.
Vic, honestly, you and your puns.
That you've got to admit. Just rolls off the tongue.
Well done. Yeah, nice work. If anyone would like to get Vic's emails, she puts, as you can tell, a lot of time, energy, love, thought,
laughter,
incredible sense of humour into them.
I honestly sit there
we'll
laughing.
Link them. Oh, God. Really? At your own jokes?
Yeah.
It doesn't surprise me. We'll link if you want to join and make sure that you get them and just be part of our newsletter, then we'll put that in the podcast show notes. But we did want to quickly touch on one thing in the election.
Yes. Just lastly on the election is Warren Buffett has come out and said that he is not going to endorse either candidate. Interesting because his daughter has come out. His daughter's called Susan.
Oh. Cute. Of course, he's got a daughter called Susan.
She's on the board of Berkshire Hathaway, which is his investment company. And she has blue dots outside her house saying that she is in support of Kamala Harris. And so people are like, Warren, when are you going to come out and support Kamala as well? Because he has previously endorsed Barack Obama and Hillary Clinton. So
in terms of the blue parties.
Yes. Yeah. So everyone's waiting and he hasn't come out and endorsed. So not that it matters, but people of influence like that, they're big swing factors for a lot of people, especially the older demographic.
What I think is quite interesting, and this is something I didn't realize until we recorded our election episode, is how intertwined money and the stock market and politics are. And the reason that this is being brought up and why it's so interesting is that Warren Buffett obviously invests a lot. He's one of the grandfathers of investing, and whoever's in power, the corporate tax cut, so how they tax businesses, really impacts the economy, right? So that's why a lot of people will be looking to Warren Buffett to be like, well, based on how Kamala Harris and Donald Trump are approaching the tax cuts for businesses, people will want to know what he thinks of those, but it's quite interesting he's not taking a stance.
I see it as he's like, you know what? History shows that no matter who's in power, the stock market always goes up. Doesn't really matter over the long term. And he probably also, he's not a political person. He's an investor. You know, why is everyone coming to him for his political views?
I would say Warren Buffett has created a name for himself as not only an investor, but also a good person. And so there's a lot of people probably wanting to know because it will help influence their decision because they have a lot of respect for him as a person. So I think it's, Anyway, if you want to learn more about that, it's a most recent Raising the Curve episode. What's been going on with Tesla? This is interesting because Tesla for so long when we've been talking about it, you've been saying is going down the toilet.
Yes, down the toilet.
Has there been some better news?
So as a lot of you may know, by listening to us for a long time now, there is a thing called corporate earnings season. Or financial earnings season. And it happens 4 times a year. Anyway, we're now in earnings season. So a lot of companies are reporting. there'll be a lot of movements in share prices. Don't freak out. Tesla has come out and said that it has done fantastically well for the last 3 months and its stock price was up 20%.
Damn, I knew this would happen.
Did you take it out?
Yes, because I had a blowout and I invested too much.
Sophie.
I know. And as the last few times that we've been talking about their share price being down and not doing well has made me think, why am I not buying the stock? And I just forgot. And I knew something like this would happen.
You own the S&P 500.
True.
Yeah. So it's a big percentage of the S&P 500. Anyway, it's had a blowout quarter, which is great. It was up 20% this week, but it's only up 4% for the year. So it has gone down, and then now this 20% is kind of like boosted it up a bit at the end. So it's only up 4% and the stock market's up like 23. So it has, you're right, been in the toilet for a while. The last 4 quarters, it's had terrible results. So people are almost throwing in the towel, but it also gave a really positive outlook in terms of its production. And it's all around the Cybertruck. Have you seen the Cybertruck? Mm-mm. It looks like Back to the Future vibes.
But what is it? Sorry.
It's a truck version of the Tesla.
Oh, that is so ugly.
I know. Imagine driving around in that.
That looks like an origami car.
It looks like it's out of...
Wow, that is just so hideous.
But also, they also announced that they plan to roll out like ride-hailing services for Teslas.
What do you mean hailing? Because that to me sounds
Uber, like Uber, like in a ride-hailing service. So you can order a self-driving Tesla to take you from A to B.
Wow.
Yeah.
I mean, the great thing about that...
And what do you think happened to Uber and Lyft's share price with that announcement?
Down?
Yeah. Yeah. It only fell a little bit, but yeah, they're going to have a competitor in Tesla.
Okay, let's just discuss...
Sorry, yeah.
Exactly what you just said. For anyone that wasn't immediately thinking, what do you think happened to Uber and Lyft's share price? And I said it went down. For people that are like, what? Why?
Right, yeah.
Let's talk about that.
So Tesla announcing this is a new announcement. And so investors in Uber are like, oh gosh, here's this giant company, Tesla, who is going to now be encroaching on Uber and Lyft's market. So I'm going to sell my Uber shares or my Lyft shares. That's what you'd be thinking.
Well, that's why
the share price
dropped.
goes down. Yeah, it's because people are like, oh gosh. People that held their shares would be like, well, you know what? Uber's killing it and
diversifying. We spoke about this last week.
Yeah, we spoke about in terms of how they're becoming more logistic. They want to take on Amazon and become the super app and all that. I don't know what's going to happen.
I feel like I would still back both.
Yeah.
I don't think that that's enough of a reason to just all of a sudden decide you don't back a company personally.
Yeah, you should read headlines like this if you do own shares in Uber and Lyft or anything. If you owned like Starbucks and then McDonald's was like, we're going to do a coffee chain and we're going to roll out hundreds of thousands of stores around the country. It's like there's only a certain amount of money that people spend on coffee. And if that's now split between 2 rather than 1, you know, like you've got to think. Yeah.
I know, but I don't know. I feel like it's so reactionary.
Yeah.
To all of a sudden in the entirety of the world to think that if McDonald's opens like a frozen coffee chain,
Frappuccino,
that all of a sudden Starbucks is going to absolutely crumble. It's like, how many people drink coffee? What is the brand?
It's not crumbling though. Like their share price falling a little bit is just like, oh, now their market's probably gone from this to this.
But that's what I mean. I'm like, what is with the weird need to make a decision when news comes out? That's what I don't get.
But I think with this is like, yeah, you're right. You don't need to be reactionary. And I think that's definitely the big takeaway from this. We're in earnings season. Stocks are going to jump around. We could have Uber or Lyft coming out in the next couple of weeks with really, really good results. And you'd be like, damn it, I sold.
But you sort of just said, don't make a decision based on what's happening in the market in the short term. But also you might look back and you're trying to be forward thinking and you might regret not having sold based on the news that came out. Those are 2 quite different approaches.
Yeah.
So what do you mean? I'm like, don't confuse me. I need very direct comms.
Diversify. So own both because you don't know what's going to happen in the next 10 years. But they're 2 great companies. Uber and Tesla are freaking killing it in my opinion. And in the next 10 years, both companies are going to be a lot bigger and stronger than they are today.
I think the same. Okay. Great. Yeah. Okay, and moving on.
Goldman Sachs, which is one of the biggest investment banks in the world.
And investment banks is people that are professional investors that invest on behalf of everyday people. So say I had $10,000 and I wanted to give it to Goldman Sachs, they would manage that money for me.
Or companies. So say the Curve ended up making millions and billions and billions, and we'd be like, cool, we want to give some money to Goldman Sachs to manage for us. Or say we were a KiwiSaver or a pension provider, we took lots of money in from people, we needed to invest on their behalf, we give it to Goldman Sachs. Like even like the Revoluts of the world, you know, when you've got money deposited there, they need to put it somewhere else and earn a return. So they're investing part of that. All banks do. It's not just money in the bank sitting in your little deposit account. That might look like it on the screen, but they've taken that money and they're investing it so that they can.
There's a whole other conversation for another day.
What? My money's not there?
Just
Don't go around on the banks.
I'm going to just totally ignore that and just pretend I never heard it, and we'll go into more detail on that another time.
That's exactly the bank's mentality.
I know.
They take money in and they lend it out.
I know,
they keep a little bit in between as a security blanket.
Oh, God. It's just too much for my brain right now.
So if you've got money with ASB at the moment.
I love that you're just pushing through and I'm trying to.
No, because I'm like.
Okay, fine, tell me.
If you had money deposited with ANZ in New Zealand, I could actually have your money because I've got a mortgage. So they've lent it to me. They could have lent me your dollars because you put the money in as savings and I have got a mortgage with them. So.
That sounds way riskier than everyone talks about the banks. You know, it sounds like everyone's like, the banks are so secure. It's like, are they?
Well, they have strict requirements. They can't lend it all out. So if you deposited 10,000,
no, you bloody hope so.
If you deposited 10,000 in the bank, they're not lending me 10,000, and then I don't pay it back, and they go to Sophie Hora and go, sorry. No, it doesn't work like that. They'll lend 5,000 and keep But anyway, that is a conversation for another day. How banks work. Sounds like a fun episode.
God, let's not.
Anyway, so yes, Goldman Sachs is like that. Because they're one of the biggest banks, they have teams and teams of the best economists, analysts in the world. And they have come out publicly and said over the next decade, the S&P 500, which is the top 500 companies in the US, will return only 3% per year on average.
How on earth would they know that?
They've done all data, and analytics.
And so when you read something like that, how would you interpret it?
If we look at it in perspective of, okay, what has the previous 10 years returned in terms of the stock market? And it's delivered 13% per year. So over the last 10 years, we've had an average return of 13% per year. And now they're expecting 3% going forward. So everyone's like, why would I invest in the stock market if all I'm going to get is 3%? Like that seems stupid.
Also, how do they even predict that?
So their analytics and what they've based that on is the fact that the stock market's delivered 13% return per year for the last 10 years. And the historic average over the last 30, 40 years is 10%. So we are well above that average. And so they're saying there has to be years where it's below average in order to get back to that long-term
But
average.
Years is not 10 years. Did you just say a whole 10 years of them not returning more than 3%?
Yeah,
That's
so 3% per
shitload.
year for 10 years.
That's nothing though.
Well, we've done 13% for the last 10 years.
That's what I mean though. So like why?
So it's what you call mean reversion. So you have to come back to a more normal environment or more long-term average. And the main crux of it is the fact that the S&P 500 is dominated by what we call
the Magnificent Seven.
The Magnificent Seven.
Yes.
Oh my God, why can't I say that? Magnificent. Which is
Apple.
Yep.
Tesla.
Yep.
Alphabet.
Yep.
Amazon.
Yep.
Nvidia.
Yep.
Oh my fucking God, I've got 2 to go. McDonald's.
No, close.
Microsoft.
Yep, but it's one. Another one.
Facebook.
Yeah, which is called Meta, yes. So that's the Magnificent Seven. And their concern is that they've got way too dominant in terms of their percentage of the S&P 500.
Is this rare? Is it rare for only a few
Never
companies?
happened in history that these Magnificent Seven or any Magnificent Seven have been 30% of the index, the S&P 500.
Right. And so all of this data, like we spoke last week or the week before about Google potentially being broken up.
Yeah.
This probably is all feeding into it, because if the idea of all those Magnificent Seven get broken up.
It's more if you've got these 7 companies which have done so well, like Nvidia's done 150% this year. It's more they have done so well and got so big. Goldman's prediction is that if they stop growing or grow at a slower rate, which you just have to, if you're getting this big, you can't keep growing like that, means that that's going to affect the overall stock market performance. Even if you have all these little companies doing 100, 200%, it's not going to move the needle enough in terms of how much these big companies have grown over the last 10 years.
But does that mean though that if you're looking at that and thinking, okay, maybe those 7 can't do as well as they have.
Yeah.
But I think that AI is going to accelerate so much in the next 5 years.
Yeah.
Does that mean you could then go and invest in an AI ETF?
Yep.
Because it's more heavily leaning towards things that I personally think will be growing more.
Yeah, it just means the S&P 500. So that's
and it's
what they're
because
talking about.
those 7 are really pulling the index so much.
They've pulled it so much over the last 10 years that they're like the next 10 years, it's almost like you need to create space for these other companies to grow, but they're not going to grow nearly as much as these 7 have.
Which means the overall average will be down.
Yeah, much lower. It's still growing about 3%, but it's not much. It's kind of like a running race. You know, if you had someone running really, really fast and they had all these other people running really slow in their team, then I'm trying to think of another analogy of like.
I know what you're trying to say with the running analogy.
Yeah.
Okay, so let's say you're in a running race. Let me start.
Yeah.
You're in a running race and, you know, it's a marathon and you've got these people that have absolutely sprinted for 27 kilometers and then all of a sudden they're like, oh, wow, I forgot to bring my, what are they called? Sugary pouches.
Yeah.
And I'm starting to lose a bit of power and I'm getting a bit tired. And the other ones will slowly catch up.
Yeah.
But then maybe not as fast as the other one. So it's kind of like the whole race is just going to be a little bit slower.
And it's like, say every kilometre was a year, you know? So the first kilometre, woo, we got there really quick. Yeah. Second kilometre, woo, yeah. Really, and say quick is like high return. Yeah. And then as you get later on, you're like, oh gosh, now we're falling behind. Oh, we're not getting there as quick, or we're not generating as high a return.
My immediate reaction is, why would I invest in the S&P 500? Why would I go and want to get an average of 3% over 10 years when I could just keep it in the bank and get the same?
Yeah.
So what would you say to people that are feeling like, oh, well, God, that's really demotivating. I don't want to go and put my money somewhere that could be having such a boringly slow return. We go on and on about the idea that the S&P 500 has returned over 10% for the last 30 years.
Yeah.
And then all of a sudden you hear this news that, it's going to be 3% for the next decade. It's super disempowering.
So I tried to find the prediction from 2014.
Oh, I love
that
this.
Goldman's did, and I couldn't. But what I started thinking about was like, what has happened in the last 10 years? We've had 13% return on average per year, and we have had a pandemic. The stock market was down 30%. We've had 40-year high inflation. We've had interest rates that have gone from 0% to 6% within like even 4 years. We've had a cost of living crisis. We have an AI boom. We've had cryptocurrency become more normalized. There are so many things there that Goldman's could not have predicted at all. And so, yes, they've come out and they've said this, but that's not to say they're correct. There's so many economists and analysts that have to prove their worth and come out with statements like that. And, you know, like, gosh, I was an analyst once. You know, you come out and you're like, no, yes, but like the world changes. I honestly feel like this is just a bit of a headline grabber. I get the whole point about the rationale in terms of the index and how concentrated it is and how there may be a bit more of a slowdown in terms of those 7 companies can't grow as much. But I just think that nobody knows what's going to happen in the world in the next 10 years. And if you're diversified, then it doesn't really matter.
I'm still not convinced. I need more motivation. Because diversification is the S&P 500. It's like the epitome of diversification because there's 500 companies.
There's actually, you can invest in an ETF that is equal weighted.
What does that mean?
So instead of market cap weighted, which is what the S&P 500 is, so it's weighted based on the market cap of the company. So if you're Apple and you're a $3 trillion company, you're a bigger percent of the index.
Oh.
Whereas there's an equal weighted index, which is no matter what your size, you're going to be 1% or 2%.
Oh, that's interesting.
So that would do better.
How would we find that?
You just Google equal weighted S&P 500 ETF.
Oh, that's a good hack.
Yeah.
Love that.
Yeah.
Cool. Thank you. That's what I needed to hear.
No worries. And lastly, luxury. There's been a bit of toiletness, maybe.
Don't know if that's what you're looking for. Like poor performance from the luxury.
Yes.
So luxury brands essentially recently have not been doing super well.
No. They have a heavy reliance on China and Chinese people buying their products. But like I said, we're in earnings season at the moment, and Kering, who owns Gucci, as well as Balenciaga, Yves Saint Laurent, Bottega, Alexander McQueen, owns a lot of brands, but Gucci is over 50% of sales still. They have come out with a bad result, but the share price has gone up.
Why?
Remember, markets are always forward-looking. So you're always looking to the future. Yes, a financial result or a company reporting a financial result is relevant because it's the most relevant financial result that you have, but it's the outlook or the guidance or the commentary that management makes about the future of the business that's the most important thing out of any financial result. And so because all these luxury names have been doing so badly, people are like, this must be the final bad result. So they're looking forward and going, this is the bottom. I'm going to buy these stocks now.
But what makes them think that people will change the way they spend and all of a sudden be able to buy expensive luxury brands?
Remember we spoke about the fact that China announced that it had pumped billions and billions of dollars into its economy to help stimulate its economy. Mm-hmm. So that's not been reflected yet in these luxury brands because it's only just happened. So that will eventually flow into people spending, or Chinese people spending on luxury products.
I reckon that's a stretch.
Do you reckon?
Yeah.
If we were in New Zealand and the government announced billions and billions of dollars to help relieve, to make sure that everyone had jobs, make sure they got pay rises, make sure that the property prices were propped up, that's eventually going to reverberate into, I actually feel okay. I'm going to buy a luxury handbag. But I think it's more of a case of things can't get any worse. Kering's profit is back to where it was in 2016.
Whoa.
Yeah. So it's fallen to its lowest level since 2016. It might be one more bad result. It might be two. But people are like, it's fallen so far, I'm going to nibble. I'm going to have a little nibble.
So people are trying to time the market when it comes to luxury goods.
Yeah. They're going, okay, it's fallen a lot. These companies are
interesting.
Stable, quality companies. They're just having a bit of a bad run. I'm going to buy it.
I'm feeling quite inspired to buy. I don't know if I'm in like a buying mood or if buying has anything to do with my cycle, but I'm ovulating at the moment and I'm thinking, I want to buy. I want to buy luxury brands. I think I want to buy Uber. I think I want to buy Tesla.
You know that's actually a thing?
And I think I want to buy that equal weighted ETF. I think I'm going to go shopping.
Nice.
What's the thing, sorry?
Feeling risky while you're ovulating.
Really?
That's a whole nother conversation.
Oh my God, really?
Women, if you're listening, buy shares when you're ovulating.
But is that a good thing though? Are we wanting people to buy when they're feeling risky?
Well, majority of women don't take enough risk.
Imagine if we created a product that encouraged people to invest while they were ovulating and we were like, invest when you're feeling frisky and risky.
Or we did like a test group. We had like women that invested on their period and women that invested when they ovulate and see the performance.
Oh my God.
Oh, brainwave. We got to go.
We got to go. We've got things to do, people to see.
Oh, thanks everyone for listening.
Loved it. Thanks so much, Vic.
Thank you so much for listening to The Curve Weekly. Make sure you hit the subscribe button to stay up to date with all the money, biz and stock market news. And if you like what you heard, we would love a review. Thank you.
Yes, we would love a review. But if you did hate it, please, don't leave one if you hate it. No, but in all seriousness, could you please leave a review? Because it really helps other people find our cute little podcast.
And we hope you have a good week and see you next Monday.
Bye.
Bye. Sweet. Nice. Yeah. See you next Tuesday. Lol. See you next Tuesday. I mean Monday.
No, actually though, new episodes out every Tuesday.